Hi, I'm Max Keiser. Welcome to the Keiser Report. Jump down, turn around, pick a bale of cotton. That's right, you remember that from the old days, old plantation days. Well, turn around and pay your rent. To me, I'm a bankster, and I own you. Yeah. It's nice to be a bankster in these days of 0% interest rates, printed exclusively for the bankster. Stacy?
Max, you sound like somebody from KKR there, one of the banksters of the world. London bankers become landlords as rents hit record. So London rents, Max, have risen more than 6% in the past year to a record, even as job cuts by banks reduce employment in the financial services industry to a 20-year low. Technology and media companies are drawing workers to the city, while lenders restrict mortgages to all but the most credit-worthy customers. That's encouraged individual investors and companies, including KKR and Company, to enter the rental market as central banks push down yields on debt to record lows.
All right, so this is a classic case of rent seeking. You've got the central bank and the investment banks. They're colluding. They got interest rates down near zero. So jacking the price up. The rents are going higher. KKR, predatory bankers in the mix. It's the result of a completely ill-conceived monetary policy. It's causing massive rent-seeking and financial dislocation.
Well, it's also something that you've called before the Jim Crow laws. So any ordinary person, the bottom 99.9% of the population, they are excluded from 0% interest rates. It looks great on paper. Wow, 0% interest rates around the world. Record low gilt yields, record low yields on treasury bonds. It's super. We can go to the Fed's discount window and borrow at 0%. Well, actually, you can't unless you're a bankster.
Right, it's financial Jim Crow laws, so it's fine using interest rates to discriminate.
Yes.
If you are, in the big house, so to speak, you can borrow money at close to 0%. If you're out in the field working, then your rate of interest is going to be 25, 30%. Your rates are going to be jacked up. You're shopping at the company store, whether it's Tesco or Walmart.
Now, demand for rental properties is growing because first-time buyers in the city typically need down payments of about 25%. The average deposit is £57,175. Now, consider that. That's almost twice what the average annual salary here in London is. So, of course, I mean, had we had this from the beginning and we never had that financialization and the boom and the lowering of credit standards, of course, we would never have prices at this level if from the beginning we always had a 25% deposit. But now people are being forced out, excluded, and it's bankers who are able to borrow at 0%, like KKR, and they go over a whole list of other bankers who are buying properties and renting them out.
Right. Well, the flip side of 0% interest rates are bond prices at 300-year highs. And so when the bond price bubble pops and interest rates go to 10, 15% on the 10-year, 20-year, 30-year bond in the UK and around the world, the real estate market will crash. So will KKR. But because they live in the big house, KKR will be bailed out again by the state, and everyone else will be suffering through another round of austerity.
Exactly. So let's look at another headline here because, our economies have also been wiped out. As they even note here, even bankers are losing their jobs. There are fewer jobs available. But do you want to be one of these sort of rentiers that want to join the KKR class? Well, they've got just the product for you. KKR's goal: to expand to ordinary investors. KKR and Company is seeking to appeal to individual investors and their advisors searching for yield as the private equity firm diversifies beyond wealthy and institutional funders. That's really what our long-term goal is, to be able to meet the demands and needs that you have.
Well, this is a bell is being rung that the bond market is at a top because Colbert Craverson Roberts, KKR, is packaging all of their long-term interest rate risk into a new security that they will make public and have the public buy into. The public is now going to be buying into KKR's long-term interest rate risk, just at the top of the bond bubble. This is a brilliant sign that the bond market's about to crash. Anyone buying into this KKR scheme is going to lose 75, 80, 90% of their investment. KKR will be insulated because they dumped their risk into this vehicle that they're now pushing onto the public. The regulators are, of course, implicated in this. They let this go through because they're corrupt and they take huge bribes, whether it's Gary Gensler, the CFTC, the SEC, the FSA, it doesn't matter. They're all corrupt. They take huge bribes to let this trash get into the marketplace. KKR offloads their risk. The public, they are exposed to austerity. And then what pennies they have left, they get raped by KKR. Henry Kravis, you are a true patriot.
So investors such as public pension funds and wealthy families have cut severely their investments in private equity. They were primarily the big investor in these private equity firms. They're cutting back. So now KKR needs some new chumps. You know, you're always looking for the next chump to sell your investment to. So this is how Scott Nuttall, the firm's global head of capital and asset management, says individual investors and their advisors should consider moving more money toward the spicy credit, such as high-yield debt and distressed companies, which KKR's two new funds invest in.
Well, Nat Numbskull, advisor to the Bozo the Clown contingency, of course, another guy who's taken a big commission up front to help KKR offload their risk to the vast majority of idiots behind me and around the world who will be sucked into this vortex of guaranteed capital loss.
Well, you know, we've talked about this 30-year bond market many times over the past 3 years on this show. And this is surely a sign that this sort of thing is ending, because KKR and Blackstone are the two big giants, and Carlyle Group, those are the three big giants of the private equity world. And if they're looking to share it with Joe Bag of Donuts, you can bet anything that they don't have much but bad bonds and debts to get rid of at this point.
Right, they're the seller. Now, why would the smart insiders selling off this property, why would they be selling it unless it was, in fact, a bag of worms that they were selling to the public to get rid of the, you know, there's an old saying on Wall Street that the best time to feed the ducks is when they're quacking. You need to feed the ducks when they're quacking. So the vast majority of the population out there, having had their interest income on their pension accounts guided down to zero by the corrupt central banks of Bank of England and the Federal Reserve Bank, they're quacking for yield. Quack, quack, quack. We want yield. So in comes Henry Kravis and KKR, packages all of his risk on all these private equity deals that were financed by junk bond, takes all that risk, puts it into a new entity, floats it on the public exchange, and Johnny Numbskull here, the professional consultant advisor for the finances of millions and billions of people, end up buying into that risk. Guaranteed capital loss. Quack, quack, quack. It happens time and time again. It happens every 3 or 4 years, like clockwork.
So you did mention the 300-year record high in UK government bonds. Well, the UK is in this next headline here, Max. UK public borrowing jumps in blow for Chancellor. The Chancellor, George Osborne, was dealt a major blow as the last figures before his crucial autumn statement showed borrowing was far higher than expected in October. So, Max, the UK government borrowed £8.6 billion compared with economists' forecasts of just £6 billion, which is what they borrowed last October. So, as you see, it's a spiraling out of control situation here. And it was mostly due to the lower corporate tax receipts.
Right, because the economy is shrinking due to the scandals of the banks, the four horsemen of the paper apocalypse: Royal Bank of Scotland, Lloyds, HSBC, and did I mention Barclays? So these are the four major protagonists in a tragedy called the killing of the UK economy. And George Osborne, of course, and David Cameron, they're going to need the global market to buy their debt. They need more debt to keep themselves afloat, even though the country's gone completely into a zombie state. So what is Cameron doing to the Eurozone, which could be a natural buyer of his debt? He's saying, no, we don't want to be a part of the Eurozone. He's antagonistic toward his boss, Angela Merkel. You know, he's antagonistic. Who's going to be buying the bonds of the UK to finance their economy going forward? Not the Eurozone. No. Who's going to be buying these bonds? Oh, KKR? They can sell the Tower of London for 10 cents on the dollar. Sell Buckingham Palace for $50 billion, and let's get over this whole royalty thing, because that's a big waste of money. They got do a leverage buyout of Buckingham Palace. Do a leverage buyout of the Queen and all the spawn of the Queen and the Duke, and get rid of this debt. put them on a stamp, put them on a flag, but get rid of them as physical entities because they're mucking up the economy.
As soon as you threaten that, of course, there will be a genuine old-fashioned debt jubilee. The Queen will say, I dispense with this debt. It is gone, KKR.
Well, you know, Queen, listen to me, Queen Elizabeth. KKR is in your backyard threatening you. Declare a debt jubilee for this country and drive the snakes of KKR and other private equity groups out of Britain. Do your country a favor, Queen Elizabeth. Drive out the snakes of Kohlberg, Kravis, and Roberts.
Again, though, this is the end result of financialization. Here you have the banksters, derivatives products, fraud out of the City of London. And the Office for National Statistics figures showed a near 10% fall in corporation tax receipts. So there's nothing else left in the economy other than their fraud and Ponzi schemes. So when those start to contract, the whole economy contracts because there's nothing left here to fill in the gap when all those schemes fall apart.
There's Marmite. There's Marmite for everyone. No, the country's gone zombie. 1 in 10 companies is a zombie company. 160,000 companies can't make enough money even to pay the interest on the debt, let alone retire any of the debt. And that problem is growing. The country itself, as Osborne now points out, has become a zombie country.
Yeah, and as they say, those zombie companies are being kept afloat by 0% interest rates. So if interest rates go up even a fraction of a basis point, they're going to be wiped out. So how is that going to affect future borrowing from the UK government at these historic low yields?
Right, and if you ask me when is this bond collapse coming, I would say if Kohlberg, Kravis, and Roberts is now bundling all their bond risk and selling it to the public, then the timing is now. All right.
Well, it's a full circle, isn't it? Because it's back to the bonfire of the vanities is where it started, and that's where it's going to end.
Well, you know, it gets back to the old adage that if you don't know who the sucker is at the poker table, it's you. David Cameron is that sucker. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Stay tuned for the second half. I'll be talking to Ian Williams about silver. Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to turn to Ian Williams, who is Chairman and CEO of Charteris Treasury Portfolio Managers. Ian, welcome to the Keiser Report.
Okay, thank you.
Okay, Ian Williams, you recently made headlines with a very bold prediction for silver. You say that silver will rise 5-fold in the next 3 years. Tell us about it.
Well, it's based on a combination of technical and fundamental factors, cyclical factors as well. And one of the interesting points, looking at the cycles in silver, there's an almost perfect 10-year decennial pattern in silver. And then every year since silver was floated, since gold was floated in 1970, every year, with the year ending in 2, has marked the major bottom in silver. Every single bear run has ended in a year ending in 2. And we're now in 2012. Okay,
now viewers watching some of them will listen to this, and it sounds a bit arcane to them. This idea that there's technical patterns that years ending in 2, etc., would drive the price. However, the biggest money in the world, the hedge funds out there and money managers out there, of course, they incorporate technical analysis in what they do, their decisions, and what they allocate resources. So it doesn't matter if the average person out there kind of buys into the technical analysis or not. The fact that the major money is, and they've got a lot of money to spend, it becomes almost, I wouldn't say self-fulfilling prophecy, but it definitely informs their buying decisions. And if you bring in these big buyers, what is the current composition of the largest portfolios in the world today, allocation toward gold and silver? Because the last I checked, it was very, very low.
It was very low, about 1%.
1%?
Yeah, probably about that, yeah.
Of investable assets around the world are in precious metals?
Well, precious metals stroke gold and silver mining stocks, yeah.
Now, any bump in that number at all would seem, you take the silver market, which is only 1 billion ounces above ground, that's a, what, a $32, $33 billion market. We're talking about portfolios that are 500 billion in size. Correct. If they just go from 1% to 2%,
that's correct.
Tell us what happens.
Well, you get a rather sharp upward movement in the price, which is historically. See, if you're in a precious, if you look at fundamentals for a second, we think the biggest fundamental driving all these bull markets in precious metals is money printing by the central banks, led by Ben Bernanke at the Bank of England. Looks like the Japanese central bank are going to be at it soon. Chinese central bank. So all the major central banks in the world are all effectively got their foot right rammed down hard on the money printing machine. Now, if you're an investor in precious metals, any precious metal, this is the best backdrop you can have. And if that's the case, if we're in a bull market for precious metals, it's 99% probable that silver will outperform gold. Silver will go up more in gold. It's higher beta. It's from a lower base. Every time you get a bull market in precious metals, you would expect silver to go up a much greater percentage than you do gold. So if you believe the precious metal story, you should buy silver rather than gold. And if you don't believe it, you shouldn't buy either.
Okay, I want to talk about silver versus gold in a second, but sticking on the central bank theme, over the past 5 years, since the beginning of this big crisis, the central banks around the world have increased the supply of their bonds or money by hundreds of percentage points. In the US, for example, they've gone from roughly 15 to 45 trillion increase in paper that they're floating from the government. During that period of time, the supply of gold is up maybe 8%.
That's correct.
So here you have gold up 8% supply, not the price, but the supply, and the supply of paper is hitting up multi-hundreds of trillions of dollars. And so, once again, we covered in the first half of the show, I'll get your take on this, Henry Kravis of Kohlberg, Kravis and Roberts. They are now packaging their private equity into a public offering, giving the public a chance now, finally, to take a piece of KKR after years and years of being a private equity firm. Isn't this kind of like ringing the bell that the bond market's is over, the rally's over, and we're heading for a crash?
Well, I think almost certainly you are heading for a crash in the bond market. I think sort of US Treasuries and UK gilts are the most overvalued assets on earth. And we also run a gilt fund, so it's not as if we have any great vested interest in pumping gilts. I mean, yields on 5 and 10 year Treasuries and 5 and 10 year gilts are now below where they were in the Great Depression. Well, you know, things may be bad out there, but they're not that bad. Okay, let's get back to gold and silver. So there's traditionally a ratio between the two.
Yes. Right now it's, I believe, 52 to 1, silver to gold on a price basis. That's very extended and not the norm. Talk about that.
Well, it depends how far you want to go back to try and guess what the norm is. If we're correct in what we're saying, is in that in a bull market, silver will go up a lot more than gold, then that ratio is obviously going to move a lot more in favor of silver.
Well, that drives part of this rally in silver is that the compression of that ratio. So it goes back to the more historical 16 to 1 or so.
Well, also, I mean, if you think about other things as well, China, for example, has just introduced a new futures exchange in silver, which with a much lower denomination contract. So there's lots of people in China who can afford to buy silver and silver coins, but they can't afford to buy gold coins. It's often referred to as a poor man's gold. So it's mass market. I mean, if you're an investor and if you're getting virtually nothing on deposit, you're getting nothing in the bond market, and you're worried that all this money printing is going to cause inflation at some stage, gold and silver are the best things to turn to. But there's a lot more, the audience that can buy silver is much, much greater than can buy gold.
Let me get your thought on this also, is that if we're heading toward this collapse in the bond market and gold and silver once again becoming strategic and probably being monetized by at least one country, possibly China, the fact that Britain only has 300 tons of gold, how badly does that position them for this future realignment?
Well, I'm not sure it will be monetized in the way that it used to be monetized. The Basel Agreement for banks' capital ratios is going to allow gold is going to move up from having a 50% risk weighting to 100% risk weighting. So it's probably going to be private sector, i.e. the commercial banks, starting to buy gold and use that as a monetary reserve rather than necessarily the central banks doing it. I mean, most of the the Bank of England selling gold at $250 an ounce was one of the most foolhardy things anyone's ever seen.
Well, now we know why, because they were caught without the gold, and they had to manipulate the market, and Gordon Brown committed a heinous act of high treason, economically speaking, but I'm sure he does well on the speaking circuit.
Yeah.
Now, in terms of the price, last few years, through the Gold Antitrust Action Committee, GATA, they've been very vocal in leading the parade in looking at these prices for manipulation for gold and silver. There's currently investigations here in the UK. HSBC is involved. And there's the LIBOR scandal, which, of course, shows that on a day-to-day basis, all the major banks, including the Bank of England, are involved in cooking the books, manipulating the market. Your thoughts on the gold and silver manipulation, what's going on there, number one? And number two, my follow-up question is, does it matter from your perch as a technical analyst? In other words, manipulation of prices versus the technical analysis. Does it matter? Does it sully your work as a technical analyst?
Not at all, because we've always worked on the theory that the market is bigger than any one particular player, and history has shown over and over in any market you want to look at. I mean, the market that the central banks have most tried to rig in recent times is the foreign exchange market. I mean, witness all the futile attempts by the Bank of England to support sterling at any one particular level, and the market has always won. And they had a huge vested interest in huge political will, and huge every whole establishment was over periods of time since the Second World War has tried everything to support levels of sterling.
Black Wednesday in '93,
and it's never worked because the market has always won. So, if it didn't work in foreign exchange, where there was an enormous will to keep sterling at a particular level, I don't see any reason why it should work in gold. And witness the fact that GATA has alleged that there was this sort of semi-official, official attempt to keep the price of gold down. If there is, it hasn't worked very well, because gold's gone up every year virtually for the last 12 years. So if there was an attempt to suppress the price of gold, it hasn't worked very well.
Well, some would argue that the prices has been creeping up despite the massive manipulation going on, but it seems as though the ability to keep that manipulation going is weakening, and these rallies would come as the result of the banks losing their ability to put on those naked short sales and those other silver manipulation schemes that we see out of the bank.
But why? It's never been explained to me fully. Where is the interest in central and commercial banks trying to suppress the price of gold and silver, and, as GATA alleged, gold mining shares and silver mining shares? I can't believe for a minute that the central bank gives one fig what the price of a silver mine share is doing. Unlike foreign exchange, which we talked about, where they have a massive vested interest, and they failed in that. So,
well, there's 2 points. Number one, you're saying that ultimately the market prevails.
Yes.
But clearly there's tension between paper money and gold and silver.
Absolutely.
And if you're engaged in quantitative easing, and you're committing, as the Bank of England has done, to hundreds of billions of dollars of pounds to keep interest rates low and to drive money into paper, then the corollary, the natural corollary of this is to keep money out of gold and silver. As you pointed out, less than 1% or less of the global investing funds are in precious metals, despite a 10-year bull market. Despite a 10-year bull market in these metals, less than 1% of the investable assets are in precious metals, because, in large part, it's known on the street and in the city that these prices are being managed by these banks. Now, if they lose that ability and that investment percentage goes up by 1% or 2%, a couple of things happen. A, precious metals jump out of the box and go into a huge rally. You're saying 500% jump in silver in 3 years. That's the result of having been suppressed for a number of years. I mean, it's a beach ball that's being held underwater that they're letting go, and boom, that's a huge move. Gold, where's your target on gold? Do you have a target on gold? It got me rallied up now.
All right, okay. Well, we think gold's going to go to $2,500 an ounce from the current $1,700 an ounce, which is roughly 50% increase. But that's small beer compared to what we think silver's going to do. I mean, between June and September this year, silver went up 50%. I mean, it went up from $26 to $33, and it never got mentioned anywhere. When silver gets going, silver has huge moves, far bigger percentage moves than occur in gold. We also think silver, the ratio you referred to earlier on, we think that we think silver is quite cheap relative to gold as well.
Okay, let me finally ask you a question to follow up on this. James Turk was in a couple of days ago, and he was saying, making the point that gold has had a pretty clear phase one of a bull market, it's in a phase two. Silver is still in that phase one, yes. It hasn't broken out. And what I'm hearing you say today, it reiterates this point. Yes. So, can one say that buying silver today in the low 30s, it's almost like going backwards in time and buying gold at $900 an ounce?
Yes, I think so. I mean, I think that wouldn't necessarily be the way we would look at it, but the conclusion is the same. I mean, what he's saying is effectively what I'm saying is that the upside in silver is considerably greater than the upside in gold, given the same level of money printing that the central banks are involved in.
Okay, Ian Williams, thanks so much for being on the Keiser Report.
Thank you.
And that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Ian Williams of Charteris Treasury Portfolio Managers. If you'd like to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.